How to choose between cash account and margin account for trading, and the truth about the $25,000 minimum balance requirement for cash accounts. A cash account is a type of brokerage account where the investor must pay in full for all purchases made. This means that the investor cannot borrow funds from the broker to purchase securities. On the other hand, a margin account is a type of brokerage account where the investor can borrow funds from the broker to purchase securities. In a margin account, the investor must maintain a certain level of equity in the account to cover any losses that may occur. Advantages of a cash account include: no margin interest. Since the investor cannot borrow funds from the broker, there is no margin interest charged. No risk of margin calls. Since the investor cannot borrow funds, there is no risk of margin calls. No restrictions on trading. The investor can trade as much as they want, as long as they have sufficient funds in their account. Disadvantages of a cash account include: limited buying power. Since the investor must pay in full for all purchases, the buying power of the account is limited. No short selling. Short selling is not allowed in cash accounts. No leverage. The investor cannot use leverage to amplify their returns. Advantages of a margin account include: increased buying power. The investor can borrow funds from the broker to purchase securities, which increases their buying power. Short selling. Short selling is allowed in margin accounts. Leverage. The investor can use leverage to amplify their returns. Disadvantages of a margin account include: margin interest. The investor must pay interest on the funds borrowed from the broker. Risk of margin calls. If the value of the securities in the account falls below a certain level, the broker may issue a margin call, requiring the investor to deposit more funds into the account. Restrictions on trading. The broker may impose restrictions on trading to reduce the risk of margin calls. The 3-day rule. The 3-day rule, also known as T+2, trade date plus 2 business days, is a regulation that requires securities transactions to settle within 3 business days. This means that if an investor buys a security on Monday, the transaction must be settled by Thursday. If the investor sells a security on Monday, the transaction must be settled by Wednesday. A cash account does not require a minimum balance of $25,000 to day trade. The $25,000 minimum balance requirement is only applicable to margin accounts, as per the patent day trader rule established by the U.S. Securities and Exchange Commission, SEC. If you have a cash account, you can still engage in day trading activities, but you must ensure that you have sufficient funds in your account to cover the cost of any trades you make. With a cash account, you can only trade with the cash balance available in your account and cannot trade on margin or short sell securities.